Hello everyone. I'll be continuing from the previous session on avoidance transactions under the Insolvency and Bankruptcy Code 2016. In the previous session, you went through the preference transactions under Section 45 and the undervalued transactions under Section 49. In this session, I'll be discussing extortionate credit transactions under Section 50 and fraudulent transaction under Section 66. You may already be aware that all these four transactions put together are more commonly known as the PFUE transactions, that is, preferential, fraudulent, undervalued, and extortionate credit transactions. Before I start in detail about extortionate credit transactions and fraudulent transactions, it is important to reiterate that the law has cast a duty upon the resolution professional or the liquidator, as the case may be, to identify and opine on these transactions during the CIRP process. The objective of identifying these transactions is to put the corporate debtor in the same position that it was prior to these transactions having occurred. That is, to claw back or disgorge any value that might have been created on the behest of these transactions. It is important to keep this objective in mind while evaluating these transactions. I'll be dividing the discussion into three parts. We will talk about the legal definition of the provisions of the transaction in question. We'll discuss the practicality and the various scenarios, and then I will be taking you through the case study to understand the provisions of the section a bit better. Section 50, Extortionate Credit Transaction. How is it defined under the code? A transaction shall be considered extortionate where the corporate debtor has been a party to an extortionate credit transaction involving 1. The receipt of financial or operational debt. 2. It must have occurred during the period within the 2 years preceding the insolvency and commencement date. And 3. The terms of such transaction require exorbitant payments to have been made by the corporate debtor. There are 3 conditions that have been clearly laid down by the law. Now let's understand what do we mean. The first, wherein it says there should be a financial or operational debt. The law does not distinguish that it has to be a specific type of debt. It could be either a financial debt or an operational debt. What is a financial debt? A financial debt could be more in terms of, let's say, a loan extended by a banking institution, a financial institution, etc. While an operational debt could be the payment terms, the credit terms extended by a supplier. Both of these would qualify for the evaluation of Section 50 for an extortionate credit transaction. Now, the second condition is that it should have occurred within 2 years prior to the CIRP date. Now, this is an important condition, and in fact, there's a difference here that you would note vis-a-vis compared to, let's say, Section 45 and Section 49. Section 50 talks about the look-back period being 2 years. However, you would remember that Section 45 and Section 49, in both these cases, there is a distinction made in the look-back period depending on whether the party is a related party or a non-related party. In case of related party, the look-back period was 2 years, while in case of a non-related party, the look-back period was 1 year. In this section, Section 50, no such distinction has been made. So the look-back period is a straightforward 2-year period prior to the CIRP. And third is the most important condition, that an exorbitant payment should have been made by the corporate debtor. Now, what is exorbitant? That is something which has not been defined by the law, and that is where we need to exercise our professional judgment to understand what is exorbitant. You need to keep in mind the market indices, the market rates, prevailing rates, the industry, the sector, to be able to determine whether a particular interest rate or whether a payment is actually exorbitant or not. One of the exclusions to this section is any debt extended by any person providing financial services which is in compliance with any law for the time being, it will not be considered as an extortionate credit transaction. So the only exclusion that we are talking about essentially is if a financial service provider has provided a debt in compliance with the law in force at the time. Now let's understand the scenarios. We're talking about credit transactions. So where is it when we're looking at the financials of a corporate debtor that we are most likely to find such transactions? A credit transaction would typically sit on the liability side of the balance sheet. So it could be sitting in the loans and advances extended to the corporate debtor, let's say by banks, by a financial institution, etc. Though more often than not, if it's a reputed bank, you would not find a typical extortionate credit transaction sitting there. So next comes, let's say, any loan or advance extended by the directors, the promoters, or even employees of the company. The third category could be individuals who may seem unrelated to the company on prima facie, but they may end up being a related party to the corporate debtor that we're talking about. So these are the potential scenarios where you may find an extortionate credit transaction sitting. Now, let's move on to a case study to understand a little better on how these unfold in real life scenarios. This is a case study wherein the corporate debtor happened to be an importer of plastic mold steel. It went into insolvency in June 2018. Thus, the look-back period becomes June 2016 to May 2018. The 2-year period becomes the look-back period, which is relevant for the discussion of this section, section 50. What are the case facts? We note that there were about 6 to 8 independent individuals who had extended loan to this corporate debtor at the rate of 4% to 5% per month. In fact, they had approached the adjudicating authority under section 60 of the IBC to include them as financial creditors in the COC. Now, while evaluating their plea, there were certain considerations that adjudicating authority made a note of, which we shall discuss now, to understand whether it also identified certain transactions to be extortionate. First, the money was lent at 4% to 5% per month, which translates effectively as 48% to 60% per annum. Now, if you were to consider, let's say, the prevailing market rates in India at the time, even at the highest bracket of personal loan, etc., the rate would be seemingly exorbitant or extremely high as compared to, let's say, an 18 to 20%, which we are going rate, even on a higher side. So we see that the rate that was being charged by these individuals was almost 3 times the market rate, even in the highest bracket. So definitely the payments that were being made by the corporate debtor were exorbitant. Second, the money was lent in the absence of any formal contract or loan agreement. Now, why do we need a loan agreement or a contract? Because it will mention the business purpose or the urgency, if at all, for borrowing money at such a high rate of interest. In the absence of any documentation, any agreement, it was difficult to identify why this money was borrowed at such a high rate of interest and why from the individuals and not a banking institution. There was no approval from the board of directors of SPL or the corporate debtor. Now, typically, this is an internal control failure. While the law does not say that there has to be necessarily an internal control failure, however, it acts as a supporting, supporting circumstance, supporting evidence to say whether this transaction was genuine or not. So in this case, we say that the internal control failure had occurred and there was no approval that was provided by the board of directors to borrow the money at such a high rate of interest. The fourth is that money was actually borrowed from the individuals and not banking institution. Again, the question that arises is, if the corporate debtor indeed had needed money, why is it that the traditional banking channels or traditional financial channels were not explored? Why is it that they had approached individuals who were lending them the money at such a high rate of interest? Now, there were certain contentions by the appellants in this case. The appellants contested that the transactions had occurred prior to the look-back period, which means in this case they were prior to June 2016 and hence they did not qualify to be identified as extortionate credit transactions under Section 50. The court did take note of this and said that any transaction which had occurred prior to June 1, 2016 would typically not fall under the purview. However, any transaction, if it had occurred after June 1, 2016, then it would be considered for evaluating whether it was an extortionate credit transaction or not. Another contention by the appellants were that these transactions were in fact identified by the adjudicating authority while hearing this plea submitted by the appellants. While actually the code makes it a duty of the resolution professional or the liquidator to identify and opine on these transactions. That is, they said that the adjudicating authority was not the right authority or did not have the power to identify or classify a transaction as an extortionate credit transaction. To this, the appellate tribunal ruled that the adjudicating authority has the powers to entertain or dismiss a plea pertaining to the corporate debtor as per the powers provided to it under Section 60 of the IBC, and hence this contention was dismissed. Thus, before I go on to conclude what was the final decision taken by the appellate tribunal in this case, let's go back and recap the three conditions that were given in the law with respect to the extortionate credit transaction. First, whether there was a loan, financial and operational debt. Yes, there was a financial and operational debt that was there. Second, whether or not it was within the look-back period of 2 years. Yes, there were certain transactions that were identified within the 2-year period prior to the CIRP date. And last, whether the payments made by the corporate debtor were exorbitant. We've already discussed and established that the payment made by the corporate debtor was indeed exorbitant. All the three conditions having met, the appellate tribunal noted that the transactions that had occurred within the 2-year period or the look-back period would be classified as extortionate credit transaction under Section 50 and hence were declared null and void. It may be noted here that while the appellate tribunal could not declare the transactions prior to June 2016 as extortionate credit transaction, it did declare them as unconscionable, and only the interest portion was disallowed. The entire transaction was not set aside. Now let's move on to fraudulent transactions, Section 66. What does the law say? A transaction shall be considered fraudulent if, during the corporate insolvency resolution process or a liquidation process, it is found that any business of the corporate debtor has been carried on, 1. with the intent to defraud creditors of the corporate debtor or for any fraudulent purpose. Now, the definition is pretty crisp. It says that the transaction should have been carried on with the intent to defraud the creditor. However crisp is the definition, the section becomes as vast. The reason for that is that you would note that there is no time limit that has been prescribed with respect to this section, which means a resolution professional can go back to 2 years, 3 years, 5 years, 10 years, even up to the date of incorporation of the corporate debtor to identify and opine on a fraudulent transaction. He is not restricted by the time here, which makes it extremely complex even for a resolution professional to go back and identify and look at all the transactions that may have occurred during the history of the corporate debtor. The second thing which makes this section extremely complex is the law says they should have had an intent to defraud the creditor. Now, intent is something which is very hard to evidence in the court of law. It is an intangible, it's a feeling, or you say how it is defined, it's a willingness to intentionally defraud somebody. It is very difficult to prove that there was actually an intent. The fraud could have occurred. We might have supporting documents to say there was a fraud. But to be able to say that there was an intent to defraud the creditors becomes extremely difficult to prove in the court of law. And which is why probably you would see that you would not find too many case laws around this section particularly, because it becomes that much hard to kind of evidence in the court of law. Having said that, let's understand how we can narrow down when we are looking for these kind of transactions while studying the financials of a corporate debtor. Now, frauds can happen over a period of time. There is no restriction on time, and there could be multiple types of fraud that can take place within a corporate debtor while it is conducting its day-to-day business. There can be a procurement fraud. For example, let's say a procurement head might have been biased towards a particular vendor and allocated him more business for a kickback. Or there could have been embezzlement by the cashier or the accountant of the company. Or there could have been some assets which might have been stolen by the employees of the company. Now, these are all frauds. But will they classify under Section 66? Potentially not. And the reason is these are frauds done on the corporate debtor. These are frauds which are done potentially not with the intent to defraud the creditors. Here the intent could have been making a quick buck, making quick money, but the intent was not to defraud the creditors. Hence, it's important that when we start looking and evaluating these transactions, the focus needs to be on what are the transactions which could have potentially resulted in defrauding the creditors. And some of these transactions may even sit outside of the books. Let me give you an example. For example, you see a long list of receivables for a corporate debtor. And suddenly those receivables have reduced without any payment having come into the corporate debtor's books. What could have potentially happened is that the debtors have actually paid out the suppliers outside of the books, which means that the funds never came into the books of the corporate debtor and hence were kind of kept away from the reach of the creditors. This is one kind of fraudulent transaction that might have happened. Another transaction could be excessive payments being made for purchases. This way, again, the funds are being siphoned off from the books. They are being taken away from the reach of the creditors because we are making more than the required amount of payment to the suppliers or the vendors. So, whenever we are looking to evaluate fraudulent transactions, the objective has to be very clear. We need to be focusing on what is it that will lead to defrauding the creditors or taking the money away from them. Ultimately, the entire spirit of IBC is to put the creditors in control and to give them back the money that they had lent to the corporate debtor. Hence, we need to steer away from these smaller frauds, from the management frauds or frauds which have been done by the corporate debtor rather than, on the corporate debtor rather than by the corporate debtor. Now, let's move on to a case example here. In this example, I've picked up a corporate debtor who happened to be a rice manufacturer in the north of India. This year, it went into insolvency in July 2018, and the look-back period was July 2016 to July 2018. Please note that in this case, the look-back period is not very relevant. As I mentioned earlier, there is no time restriction with respect to Section 66, and the resolution professional or the liquidator, as the case may be, is free to go back as much as it wants, as he or she wants, in terms of evaluating a transaction for fraudulent purposes. We noted that as on the date of commencement of insolvency, there was a total outstanding receivable for this debtor, about 329 odd crores, out of which 85% was due from only 17 customers, and it was due for more than 5 months. So there was a long list of, and this entire receivable formed almost 80 to 85% of the total revenue for the corporate debtor in the year. Now, when we are looking for whether this transaction is fraudulent or not, let's see what all aspects we considered. We noted that the arbitration proceedings were initiated by the corporate debtor on these 3 customers just before going into insolvency. That is, the corporate debtor went into insolvency in July 2018, and these proceedings were initiated in March to May period. And the top 3 debtors that formed 41% of the receivables were actually debtors that had been onboarded just in the year prior to the insolvency. So they were not long-standing customers. They did not have a history of having made payments in the past, and does not seemingly look like a one-off incident. They were onboarded for the first time in that year, and they had defaulted on the payment. Out of this arbitration proceedings, there were 3 proceedings that were actually in favor of the corporate debtor. However, we noted that there was no action taken by the corporate debtor to retrieve the money despite the arbitration proceedings being in its favor. This again poses a question whether the corporate debtor was genuinely interested in getting the money back. Additionally, like any other fraud investigation, there have to be multiple procedures to identify whether this transaction indeed was genuine and the parties on both ends were genuine or not. So site visits were conducted on the debtors' addresses that were provided in the records of the corporate debtor. And it was identified that the debtors did not exist. They did not have either offices or regional depots, etc. on the addresses so mentioned. It was identified not for all the debtors, but for the top 4 to 5 debtors, same things were identified, that there seemed a pattern basically wherein the debtors seemingly did not exist. Another aspect which was considered while evaluating the debtors was, and these are debtors of the corporate debtor, was what is this financial standing of these debtors? Their revenue, their assets, their liabilities, etc. seemed very minuscule and not commensurate with the transactions they had undertaken with the corporate debtor. It seemed that that was the only transaction that had taken place with respect to the business of these debtors. Now, looking at all these aspects, one may be tempted to say that this transaction appears to be a fraudulent transaction under Section 66. However, there is another aspect, which is the accounting records were not available with the CD. I would say not completely available. They were available to a certain extent, which is why we have these numbers coming in. However, the detailed accounting records were not available. Also, the corporate debtor was not able to share the documents supporting the transport of the goods and services to the debtors. So given it was a rice manufacturer, there should have been a goods receipt note, there would have been a lorry receipt, there would have been invoices, etc., to actually evidence that the transactions had taken place. None of those supporting documents were available, again making it a question mark too as to whether this transaction did actually take place or not, or whether it was just a case of inflated receivable on the books of the corporate debtor. Now here again, the question is, with all these facts known to us, can we classify it as a potential fraudulent transaction under Section 66? Maybe not. Why? Because all the documents are not available to us. And more importantly, the section says that there should have been an intent to defraud the creditor. With these facts, we may still have not established that there was indeed an intent to defraud the creditor, which is why the resolution professionals or the liquidators or the professionals managing this case may want to refrain from arriving at any conclusion with respect to this transaction being a fraudulent transaction. Sometimes we come across cases where, let's say, there was an undervalued transaction where the money has been siphoned off or given away. Some asset has been given at a very low price to evade or keep the funds away from the corporate debtors. Now, those kind of transactions, if they get limited with respect to the time limit under Section 49, they may be considered under Section 66, which talks about fraudulent transactions. So we now understand that it is not a straitjacket fits all kind of an approach when we come to evaluating avoidance transactions. We need to be careful about the background of the corporate debtor, the circumstances surrounding the situation, the supporting documents available, the other things to be considered, and more importantly, we need to exercise our skill and professional judgment to be able to determine whether a transaction would typically fall under any of these sections. It is not easy and it is not necessary that we may be able to conclude every time whether a transaction fits into one of these buckets or not, but it's important to evaluate keeping in mind everything, all the aspects that we've discussed so far. So that's all that we have in this session for today. For those who are interested in knowing more about the subject, you may refer to the IBBI red flag document, which was issued in August 2020, which it talks about the potential red flags that you may want to look at when you're looking at the financial transactions for a corporate debtor, and it serves as a redirector. Thank you.